So good afternoon, everyone. Thank you very much for joining this session on monetary policy, macroprudential policy, and financial stability. This is an ECB session organized by Luc Laeben, Angela Maddaloni, and myself. And we will have 3 papers in the sessions, and the presenters will take 20 minutes, and then there will be a 10-minute discussion, and then 10 minutes general discussion. For the participants, please feel free to write questions in the Q&A, and then I'm going to read the questions to the presenters. So I guess Miguel can now start sharing the slides. So we move on with the first presentation.
Okay, perfect. Thank you, Caterina.
Thank you.
I'll be talking about the countercyclical capital buffer today. Let's make sure that I can change slides. Okay, perfect. And I'm sure that in an audience like these, I don't have to spend much time describing the countercyclical capital buffer, the CCyB. But just to give you a brief summary, so before the Great Financial Crisis in 2008, bank regulation was anchored by this set of agreements, collectively known as Basel II, and one of the pillars of Basel II was this thing called the capital requirement that stated that bank capital had to exceed at any point in time a fraction of the value of its assets. Then the crisis happens, financial regulators from all over the world, they meet together again, and they agree on these new set of rules called Basel III. And one of the pillars of Basel III is the CCyB, the countercyclical capital buffer, which is a relatively similar rule, with a key difference now being that this kappa, this fraction of bank assets that need to be be below the level of bank capital at any point in time, is now allowed to be a function of the state of the economy. And the Bank of International Settlements issued these guidelines, these relatively vague guidelines, and there's a reason for why they are relatively vague, recommending national regulators to raise these kappa, so define a function kappa of the state of the economy such that it should be raised during periods of excess aggregate credit growth. And before all of this COVID craziness happened, these extra buffer on top of the regular capital requirement was active in some important jurisdictions such as France, Hong Kong, or the UK. In this paper, I'm going to try to answer 2 questions. First, what are the quantitative effects of the CCyB in a new Keynesian general equilibrium model, non-linear with endogenous financial crisis? And second, I'm going to bring a calibrated version of the model to the data, and I'm going to ask the historical counterfactual question, whether something that looks like the CCyB could have prevented the 2008-like crisis in the United States. The way I'm going to answer these questions is as follows. So as I said, I'm going to develop a nonlinear model of the macroeconomy where financial crises are endogenous. So the economy is going to endogenously enter and exit these crisis regions where financial crisis can happen. And these are going to be a very Mian and Sufi style model in the sense that these crises are going to trigger aggregate demand recessions. So there can be these large financial crises basically lead to a disruption of financial intermediation that's important for risk sharing in this economy. So when they happen, people are not able to risk share, and some people are going to reduce their consumption, and this is going to propagate through general equilibrium effects. So there's going to be scope for macroprudential regulation, and the key forces of the model are going to hinge on these strong interactions between household and bank balance sheets. Then I calibrate the model to the US before the Great Recession, first half of the 2000s. And I'm going to take a calibrated version of the model as a measurement device. And I'm going to use it to estimate structural shocks under what I call a Basel II regime, in which there's no CCyB, there's just a constant capital requirement for banks. I'm going to take those estimated shocks, which match the data by construction, given the nature of my experiment. And I'm going to feed them into the same calibrated version of the model, but where the only difference is that I allow the financial regulator to have access to a CCyB-like tool. And I'm going to compare how would have outcomes being different in these 2 scenarios. And here's a preview of my main results, because I will almost surely run out of time. So in terms of the first question, what are the quantitative effects of the CCyB in a nonlinear calibrated model? I'm going to find that it has both ex ante and ex post benefits. And by this, what I mean is that the CCyB is going to unconditionally reduce the frequency of financial crisis in the economy by more than half, by about 60%. But even it doesn't reduce the frequency of crisis by 100%. So there's still crisis happening in this economy. Even if a crisis happens, the CCyB offers benefits, as it's going to ensure that the banking system enters the crisis better capitalized. And this is going to be important to reduce the severity of the crisis. And then regarding my second question, what would have been the effects of the CCyB in 2008? I'm going to find that it would have prevented the bulk of the financial panic in 2008, but not the subsequent recession. And I'm going to find that the mechanism is essential. The way that the CCyB operates is essentially through precautionary motives. And I think this is interesting because it means that along the equilibrium path, the CCyB might not need to be triggered. And indeed, what I'm going to find is that in 2008, the existence of the institution called the CCyB could have prevented the bulk of the financial panic, even if it would not have been activated in equilibrium. So you never actually see it being activated. It's just the expectation that it might be activated that's driving all of that. I'm going to skip the literature just because this is a very short presentation. And unfortunately, the model is a bit complicated, so I'm just going to give you a very brief overview of how the model works. So it's going to be a very, it's going to be a very stylized tank model to agent new Keynesian model. And I cannot work with the full-blown heterogeneous agents models because I want to think about nonlinearities and aggregate risk. And basically, there's going to be two types of households, savers and borrowers. Borrowers like houses, and in order to finance the purchase of those houses, they're going to take mortgages from the banks. These banks are going to be subject to a series of frictions. They're going to be very similar to banks in the work of Kiyotaki, Corradi, if you're familiar with that. So they won't be able to issue equity, which means that they have to finance their assets with either deposits that they borrow from the savers or with their own retained earnings. And they're going to be subject to a capital requirement, which states that the value of their assets cannot exceed a fraction of the value of their capital at any point in time. And also they're going to be subject to bank runs. And I'm going to talk a little bit more about that in a second. Both savers and borrowers supply labor to some firms. And here on the firm side of the economy is going to be very simple, and it's going to be very new Keynesian standards. So there's going to be the standard apparatus that allows me to implement nominal rigidities. And these firms produce consumption goods that are consumed by both savers and borrowers. And the key ingredients of the model are going to be these four. There's going to be household default from the borrowers. There's going to be frictional intermediation, bank runs, and nominal rigidities. And I'm going to talk a bit more about some of these. So the way the borrowers work, as I said, they like to purchase houses. And in order to finance these purchases, they're going to borrow in long-term mortgages. There's going to be default in equilibrium. It's going to be completely endogenous in the model. You can check the paper if you want to see the details. But what I want to highlight is that in equilibrium, this default decision from the borrower gives rise to an equilibrium object, which is a default rule that's going to be increasing on the leverage of the borrower. So if everything else constant, if there's more household debt in this economy, default rates are going to be higher. Everything else constant, if house prices fall in this economy, default rates are going to be higher. And new borrowing, there's going to be a borrowing constraint for the borrower too. There's new borrowing is going to be subject to loan to value constraint. This is relatively standard. Then the second key ingredient are going to be the banks and bank runs. These banks are going to originate these mortgages that the borrowers use to purchase houses, and they're going to finance them with retained earnings and by raising deposits from the savers. They're going to be subject to a series of important financial frictions. So they, as I said in the beginning, they cannot issue equity, and I'm going to force them to pay a fraction of equity as dividends, a constant fraction. I'm working on extensions of the model in which this is relaxed. This doesn't really affect much the main result. Importantly, I'm going to assume that banks are going to solve a program. So they're going to solve a value function. They're going to maximize the value function, choose these things. And their optimization is going to be constrained by this capital requirement, which states that the fraction of their assets cannot exceed the value of their equity. And then I'm also going to be assuming that banks are subject to some exogenous liquidation costs. There's going to be some endogenous liquidation costs because they hold long-term assets whose prices are endogenous, but there's also going to be a small exogenous liquidation cost. And this is going to give rise to a coordination problem among depositors. So there's going to be situations in which banks are solvent. So they can, in principle, absent liquidation, they can repay all of their deposits, but they're illiquid. So if they were to, if their entire balance sheet were to be liquidated, there won't be enough resources to repay all depositors. This is going to give rise to the possibility of bank runs in this economy. And importantly, whether a run is possible or not is going to depend on the leverage of the banking system. And this variable that I'm going to call UTR, which is basically the amount of deposits that banks have to pay today divided by the liquidation cost adjusted return on their assets. Whenever this thing is greater than 1, runs are going to be possible. And this is going to be very classic Diamond-Dybvig style. And whenever runs are possible, there's going to be multiple equilibrium. These multiplicities is going to be resolved with the use of a sunspot. So a variable that is either equal to 1 with some constant probability or to 0 with complementary probability. So runs are going to be endogenous in the sense that even though there's going to be an exogenous sunspot determining whether a run happens or not, the economy needs to be in a certain region for a run to be possible. And this region is going to depend on endogenous state variables. So the way that financial crises are, what are going to be the effects of financial crisis in the model? So the model is going to have 3 aggregate shocks. There's going to be a TFP shock, very boring, does whatever you expect a TFP shock to do. There's going to be the sunspot shock that I just talked about. And there's going to be a small funding cost shock that's going to affect the saver's decision to either saving deposits or government bonds. This is mostly a quantitative thing to match stuff in the data. It's not important for anything that I'm going to be talking about today. And the way that financial crisis in this model turn into recessions is as follows. So as I just explained to you, if bank leverage is high, the economy might find itself in the run region, where a sunspot might trigger a run. Whenever a run happens, bank capital is going to collapse. And because banks are subject to that constraint, if their capital falls, this means that they cannot lend as much as they would like to, and they're only willing to lend at higher lending spreads. At the same time, it might be that the constraint that the borrower faces, that LTV constraint that I mentioned 2 slides ago, might start biting, in which case their marginal propensity to consume might be very high. Now, if banks are lending less and are lending less at higher spreads, this effectively means that disposable income for the borrowers is going to be lower because that is long-term. And if their MPC is very high, this means that their consumption is also going to be lower. And as consumption falls, house prices are also going to fall. And as I showed you 2 slides ago, this is going to lead to a rise in defaults that may be persistent. And these persistent defaults are going to hamper the recovery of bank capital. So if you combine all of these with nominal rigidities, you can see that this fall in borrower consumption leads to a fall in GDP. So effectively what we have is a banking crisis leading to a demand-driven recession, very much in the style of Miano and Sufi 2014. So this is what the state space of the model looks like. In the horizontal axis, I have bank leverage, and on the vertical axis, I have household debt. These are the 2 key endogenous state variables of the model. And this point here, this intersection is the stochastic state of the model. And here, what I'm showing you is that the model effectively is going to have 3 regions. The economy is going to be moving around as it's hit by exogenous shocks. The state variables are going to be changing. And the economy will spend most of its time in the safe region, where regardless of the realization of the sunspot, there's no run, but might occasionally enter this run region, where bank leverage is sufficiently high so that if the sunspot lights up, a run might happen. And there's also this insolvency region, which is not very interesting because the economy never goes there. It's if bank leverage is very high, then the run always happens regardless of the realization of the sunspot. And depending on the shocks that the economy receives, the economy is going to be moving around, and the borders between the regions are also going to be moving around. So what I do then is I calibrate the model to the US before the crisis, and I don't have time to talk about the calibration, but it's in the paper. I simulate the model for many periods, and then I focus on every period that the economy experiences a financial crisis. And I just take medians around these periods. And the only thing that I want to, and here I'm plotting some variables around the time that the crisis happens. And what I want to highlight is that financial crises are very costly for borrowers, so borrower consumption falls by a lot. This leads to a large drop in GDP potentially. House prices also fall by quite a bit, and costs of funding for banks increase by a lot. And some of these, especially these 2 panels, are going to be important in a minute when I talk about identification. Another interesting feature of the model is that it features these, what I call almost crises. So there might be instances in which the economy It goes from the safe region to the run region, but exits the run region without the run actually ever happening. But there's when the economy is there, there's a high probability a run might happen. And this by itself can trigger a recession in this model because people freak out because a run might happen. So the cost of borrowing for banks starts going up, and this is going to have effects in the real economy as well. So borrower consumption falls, GDP falls, etc. How does the CCyB work in this model? I'm going to take in the benchmark calibration, I'm just going to take the Basel III steady state value of 8.5%. It's going to be the kappa, the parameter on the bank constraint. In the US, the CCyB implementation ranges between 0 and 2.5%. So the Board of Governors votes once a year and can raise these 8.5 up to 11%. And I'm going to be working with a very simple policy rule, but I've done some, even if you assume other types of policy rules, most of my results will go through. But the rule that I'm going to be working with is, in normal times, the capital requirements are going to be 8.5%. But if the economy ever enters the run region and no run happens, I'm going to call this a period of excess aggregate credit growth. The regulator raises the capital requirement to 11%. If a run happens, it lowers the requirement. But as long as the economy is in the danger zone, but no danger is actually materialized, the regulator raises the capital requirement. And that's how the rule is going to work. And I'm not going to be talking about these. There's an alternative policy I consider, but I'm not going to be focusing a lot on it today. So this slide is the answer to my first question. What are the quantitative effects of the CCyB in a calibrated nonlinear model of the US? Essentially, what I want to highlight is that compare the first and the second column, leverage is going to be lower both for banks and borrowers. The probability of a crisis is going to be reduced by by more than half. And the median drop in GDP during a crisis is also going to be lower. And essentially, the way that CCyB is going to work is almost all through precautionary motives. So banks really don't like to be at the constraint. And the CCyB is essentially the regulator saying, if your leverage becomes very high, I'm going to tighten the constraint on you. So banks are like, okay, we don't want to go there. And because they don't want to go there, their leverage falls. And this reduces the probability that the economy enters the crisis region, because that probability is almost exclusively a function of bank leverage. And also there's this effect that even if a crisis happens, banks enter the crisis better capitalized. So, and this is going to attenuate some of the macro amplification that happens during crisis. Second question, data. What I'm going to do is I'm going to estimate sequences for these three structural shocks, the TFP shock, the funding shock, and the sunspot shock, using data for the US. And the way I'm going to do these is I'm going to take a sample of macro financial variables for the US economy between 2000 Q1 and 2015 Q4. These observables are going to be the trended aggregate consumption and the TED spread, a measure of bank borrowing costs. And I'm going to make the Basel II model where capital requirements are constant. I'm going to ask, what are the sequence of shocks that make the model exactly match the path of these two variables? And in order to estimate the shocks, I'm going to be using a particle filter because the model is nonlinear, so I cannot use a normal filter. This is going to give me a sequence of estimates for these structural shocks, which I'm then going to feed into a model where the regulator is allowed to follow a policy rule for the kappa. So this is what the quote unquote data looks like on the top panels. It's, these are the filtered series for the trended aggregate consumption and for the TED spread around the financial crisis. This vertical dashed line is Lehman, 2008 Q3. And these are some model implied variables. So the model believes that there was a financial crisis going on for after Lehman and for most of 2009. And here you have that threshold variable. Every time this thing goes above 1, a run is possible depending on the realization of the sunspot. And now here, this is kind of the main result of the paper. Here I'm plotting what would have happened if we take those estimated shocks and we feed them into the model with the CCyB. That's the blue dashed line. And what you see is that the drop in consumption would have been much smaller. And why is that? Because we completely avoid a financial crisis in this counterfactual economy. Why do we avoid the financial crisis? Because the UR, this threshold variable, never actually goes above 1. I think this is interesting because what this means is that the CCyB is actually never activated in practice. The CCyB is just there as an off-equilibrium threat, but it's never even activated in practice. Because we do get close to the 1 threshold, bank funding costs, which are very sensitive to the probability of entering a crisis, are still going to rise by quite a bit. but the behavior of consumption and other available variables is completely different. And actually, just to finalize, doing some back of the envelope calculations, what would have been the kind of the open gap of consumption if there, according to my estimates, if there had been the CCyB, if there had been a CCyB, I find that it would have the cumulative gain in terms of consumption would have been of almost 30%, or about $3 trillion in terms of 2007 Q1 consumption. And again, what I want to highlight is that the fact that there's the UR, the threshold variable, never goes above 1, means that we would, whatever the financial regulator had access to the CCyB, wouldn't have needed to activate it along the equilibrium path. So it all works through these off equilibrium threat. And just to summarize, so I just gave you a quantitative analysis of the CCyB during the financial crisis. I show you that it has both exposed and ex ante benefits through the lens of the model, could have mitigated financial panic, could have helped with the soft landing. You still get I still estimate that you get a recession, because at the end of the day, this is a very simple model. Doesn't have investment, for example. So in order to rationalize the large drop in consumption and output, it's telling me that the economy experienced some negative TFP shocks. And obviously macroprudential policy cannot do anything about that. And I find that the CCyB is effective even if not activated along the equilibrium path. That's it.
Okay, thank you very much, Miguel. So Ozge will discuss the paper. So she will now share the slides.
Thank you very much for an opportunity to discuss this very interesting paper. So I'm an economist at the Federal Reserve Bank of New York, so the usual disclaimer applies here. So what Miguel does in this paper, he develops a new Keynesian macro model with only consumption, so there is no investment in the model, and there's two types of households and leverage constrained banks. So I'll next summarize the 4 building blocks of the model that give rise to interesting dynamics. As I mentioned, he has 2 types of households, savers, and there's borrowers that borrow in long-term risky mortgages. And he has bank runs on deposits, very similar to the framework in Gertler, Perspitino, and Kiyotaki's recent paper. Another important feature of the model is that banks are subject to leverage constraint, but this constraint is exogenously imposed. I'm going to come back to that. But that gives rise to the need for macroprudential policy, countercyclical capital buffer. And the last piece that is required for the framework to work is the aggregate demand externalities via sticky prices. So he explained it very well why we need it. So I'll move on that. So this is a model of financial crisis. So we need to define what the financial crisis is. In his framework, crisis is defined as a period with a bank run. He defined bank run as ratio of leverage in the previous period to the payoff on that securities. This payoff is state contingent. So at time t, I would know what that is. And if this ratio is greater than or equal to 1, the bank run might realize. But these endogenous bank runs are not enough to trigger a crisis in the model. So if I know the bank leverage is high in the previous period, if the payoff in the next period realizes low, then it is likely that the crisis happened, but I will never know unless I know what the whether the sunspot shock will be realized or not. What happens during crisis? Very interesting dynamics happen. Bank leverage constraint bind and sticky prices give rise to recessionary dynamics. Miguel explained it very well, so I'll skip the doom loop, but it is interesting that when the bank equity fall, leverage constraint binds, it is propagated to the household sector. Households are also constrained. The fall in their consumption trigger a fall in prices, house prices, and the bank are holding the securities on the asset side, so their constraint is going to be further tightening. So why in the model we see that countercyclical capital buffers are effective? now I'm back to my previous point on the leverage constraint. Banks are leverage constraint. And this constraint reads as value of the bank equity has to be greater or equal to kappa times the assets. On the asset side, bank only has these long-term securities, price, and the quantity of those assets. This is exogenous again. So if the crisis occurs when the sunspot shock realizes, the model recommends a central bank should lower kappa because now the value is not as much as the assets. So the policy recommendation here is that central banks should lower kappa so that they should release the constraint, the binding constraint, to give some room for banks to adjust. If run occurs without crisis, it happens when the sunspot shock not realizing, the policy recommendation is the opposite. Central bank increases kappa to reduce leverage. So other than the fact that this run is an endogenous object and it is the ratio of leverage divided by payoff, I don't know exactly how to measure it, how to map it to real observables. But on top of that, this unobservable sunspot shock derives both the occurrence of the crisis and the direction of the policy. So I know he pins down this shock by looking at the long-run averages, long-run probability of financial crisis, occurrence of financial crisis in the data, but that would be good overall to give some sense when the policy should be activated and in which direction, given the quantitative model. So next, I'm going to move to my specific questions. The first set of questions are on the modeling framework. There was no discussion on the equity issuance in the paper, but Miguel, when he presented, he mentioned he is thinking about introducing. I strongly encourage him to think about precautionary equity issuance on the bank side, because now banks usually issue equity, right, precautionarily, when they see crisis coming, or sometimes we know from the empirical evidence, Black et al. And Barrow in 2007, they show us that the bank equity issuance is countercyclical. So we know that when they come, they precautionarily issue equity. Here, instead of banks doing it precautionarily, Miguel has a tool, kappa, so encourages banks to issue more equity or less. So the central bank can change kappa. But instead, some of it could be done by banks precautionarily. So the second, so in the first question, there's no role for equity issuance. What would be the role of introducing equity issuance? That was my first question. The second is desirability of countercyclical capital buffer arises from the leverage constraint that is exogenously imposed. I'm insisting on that because this is the centerpiece. So bank runs are at the background. It gives rise to crisis, but when the crisis happens, binding leverage constraint is key to start the whole financial accelerator mechanism. So in that sense, it is really useful to think about the ways to microfund this constraint. Gertler and Kiyotaki in their handbook chapter has some discussion on that. The other question related to the modeling framework and the countercyclical capital buffer is the kappa. So it's not clear to me what is the cost of changing kappa. It looks like central bank can increase it during boom and then decrease it during recession almost at no cost. So I would like to see what is the cost and benefit. I mean, benefit is clear. But what is the cost of changing kappa to central bank? I would like to see more discussion on that. My questions on the simulation results, he presents two sets of quantitative results. It's a quantitative model. So quantitative section, I want to see the quantitative section a bit more sound in the sense that I would like to see how it compares to the data. When he presents crisis experiment, it looks like there is no data, there is no comparison to the data. This is the first comment. But when I look at the baseline model simulations here, the blue line is the baseline model simulation and the red line is with policy. When I look at the financial variables, for example, bank spread and the house prices, with or without policy, there's little difference. Bank spread was in the baseline 3, and with kappa it is 2.75. So there is like 20 basis point decrease in the bank spread. Likewise, house prices move little. Yet the real effects are too large to me. Either the constraint of the households are too tight, or the finite, like nominal rigidities are too tight. Here I can not really tell, but the effect on the financial side is little compared to the effect of the policy on the real side. Other questions. These are more general questions, similar to some other papers. The model fails to match pre-crisis boom and slow recoveries. So this is similar to others, but I would like to see maybe, even if it's not possible to incorporate those features, it's useful to discuss those more in detail. The other issue is that, I mean, it's not an issue, it's a complicated model, but he has been doing quantitative study, pushing the paper into the quantitative direction. And what was really relevant during GFC was the collapse in investment and the rise in corporate credit spread, and the model altogether abstracts from investment. That would be nice to discuss a little bit, well, with the implications if one introduce investment into the model. So the paper is about countercyclical capital buffer, but on the household side, there's LTV constraint. I thought that would be really nice to study the LTV, the role of LTV caps. It's highly relevant for Europe, maybe not in the US, but that would be really interesting for the European case. So I think it's a very important contribution. I want to congratulate Miguel because it's really a complicated model to solve with 2 occasionally binding constraints and bank runs. Yet, when you read the paper, the intuition is very well explained. But I want to see, when I read the paper, it's a quantitative model. So I want to, and he wants to draw some policy conclusions. I would like to see a better map for the model-based recommendation for changing countercyclical capital buffers to variable observable by policymakers. And also, that would be nice to strengthen the quantitative part of the model. One way to go is to show some long-run second moments, model versus data, surrounding financial crisis, and also showing the dynamics around financial crisis, model versus data, with and without policy, would be really useful. Thank you very much.
So thank you, Ozge. So Miguel, before you answer, there is also another question from the audience. They're asking you if you have compared the state contingent CCyB with the optimally calibrated constant capital requirement. And actually, I also had this question: if you have an optimal level of capital requirement, how beneficial is to add the CCyB on top of it?
Yeah, well, first of all, thanks a lot to Ozge for reading reading that very long and complicated paper and actually making sense of it. So yeah, that's a great question. That's actually something that's related to one point in the discussion, which was what is the cost of capital requirements in the model. So that is something that I realize, I guess, I should elaborate a little bit more on that on the draft. But there is a meaningful, so even if we forget about CCyB, there is a meaningful trade-off about the level of kappa in the model. Because at the end of the day, this is a model where financial intermediation is essential for risk sharing, for making the marginal prices to consume of savers and borrowers to become as close as possible. So if you raise the capital requirement at the stochastic state of the model, you'll be reducing the size of the financial sector. And you'll be reducing intermediation between savers and borrowers, and that's going to be bad for borrowers. So overall you'll have a small financial sector and a smaller economy. So you do have a meaningful trade-off. So I haven't computed it, but I conjecture that there exists an interior optimal capital requirement. And because I haven't computed, I haven't done that comparison, Andrew suggested, but that's a very good idea. Yes, that is something I haven't done. I could do. And that is also one of the reasons why, okay, so I cheated a little bit in the quantitative exercise in the sense that when I estimate the shocks, I'm telling you that I'm estimating them under the Basel II regime. And that's not completely true because I'm assuming that the capital requirement is fixed at 8.5%, which is at the Basel III level. And the reason I'm doing that is precisely because I want to abstract from issues regarding the level of the capital requirement. Because what we had from Basel II to Basel III was a change in both the levels of capital requirements, but also obviously the introduction of the CCyB. I want to abstract from the discussion regarding levels because there's some of you in the audience have written quite a bit about that issue, and I wanted to focus on the CCyB only. But that is something that I should probably do yet. So thanks a lot for the question. And yeah, and regarding the yeah, so thanks a lot for the discussion. It's great. It's great. And some of the things are things that I've been thinking a little bit about. Other things were not really on my radar, so that was very useful. Yeah, so as I mentioned during the presentation, I'm working on the equity issuance aspect because it's I agree it's completely important. It's very important, and it's a way that banks have to kind of like go around the constraint, and it's certainly going to have effects. And the other thing that I'm also kind of I've done some work. It's not on the draft because it's still not ready for final consumption. And this is related to one of your final comments in which you say I should better map the model-based rules to what like regulators actually do in the data. So I understand that the rule I'm proposing is very stark and requires a lot of information from the regulators. So I've been playing around with more I guess you could call them more standard rules for the CCyB, where it's just like a log linear function of household leverage in the economy, something like that. And some of the most of the qualitative results go through. Quantitatively, things are a bit different, obviously. But I think the key forces that I highlighted are still there, and that's something I'm working on right now. Yeah, and yeah, the other things, the other comments are great. Yeah, some of those things are things that I haven't really thought a lot about. But yeah, I'm going to ask you if you could like send me the slides. Yeah, I think the only final comment I want to make is has to do with like the comment regarding the pre-crisis boom. I discussed that a little bit. Yeah, I think that's a problem that most models have. Without doing like funky things with like expectations or so some people do like these China shocks or these financial regulation shocks that are kind of unanticipated. It's these things are kind of hard to match. So yeah, so that's all I have to say, I guess. Yeah, and everything else I agree with everything. Yeah. So thanks a lot for your comments.
Okay, thank you very much. So if the other panelists have any other question, please interact directly.
Yeah.
Or,
can I?
Of course, Davide, go ahead.
Hi. So this is Davide. Hi, Miguel. Just a request for a clarification. I'm not sure I understood whether the CCyB is activated for an individual bank in the model or for the whole banking sector.
Sorry, go ahead.
Yeah, no, I just want to say this seems important because if I understand the mechanism, each bank is kind of reacting to the threat. So this means that it would have to be, I mean, my understanding would be that it would have to be sort of activated as a penalty on an individual bank that is sort of taking on too much leverage. Yes, no, that's a great question. So at the end of the day, it doesn't, these like details of the model that I didn't want to get into, but there's an aggregation result. So at the end of the day, I just need to work with the representative bank. And banks, and it's a big K, little k problem. So in principle, the CCyB is going to depend on aggregate conditions. So it doesn't apply to one specific bank. But banks internalize, because banks are forward-looking and they have rational expectations, they internalize that certain things regarding the movement of aggregate variables are going to change when the CCyB is activated. And they are going to try to reduce their leverage when that happens.
So what you get at the end of the day is the entire banking system reducing its leverage, given the expectation of potential activation of the CCyB. But that is a great question, because that's a relatively subtle point that is important.
Thank you. Thank you very much.
Okay, actually, Davide, you should now share the slides. So thank you very much, Miguel. And
thank you
Ozge.
all. Thank you.
And now is Davide's presentation.
Okay, so I just go on talking. Great. Okay, so first of all, thank you very much for inviting me. I'm very glad to be presenting this work here. Looking forward to all the feedback. So this is a project that I've been working on with Caterina and with Agnese. They are my colleagues at the research department of the European Central Bank, and with Ettore, that is at the Bank of Portugal. Because we work in central banks, of course, the usual disclaimer, these are our views and not the views of the institutions that employ us. So the paper is entitled Savings, Efficiency, and the Nature of Bank Runs. Right, so the fundamental question that we ask is whether banking, which generates financial instability that is socially costly, should be taxed. I should say that when I say banking in this presentation, I mean the activity of funding long-term investments with short-term deposits. So I mean maturity transformation activities. And when I say taxes, well, I take a wide definition of what constitutes a tax. It's just anything that makes, any policy intervention that makes maturity transformation less attractive, and therefore would tend to reduce the quantity of intermediation in the economy. So, for example, one famous example is paying, so a tax would be paying bank reserves at a below market rate. Another, well, you can also think of some macroprudential policies as taxes on banking. Okay, so what we find is that the answer is it depends, which is as often it is in economic papers. But the interesting thing is, what does it depend on? So it depends on what kind of financial instability we have in our model. So if we think about the financial crisis, well, we will have bank runs in our model. So bank runs that are driven by insolvencies. We will have one result, and instead, if we think we include in the model panics, so financial crises that are driven by illiquidity, we will have a different result. So let's go and see what these are. So let me just go right into the presentation with the platitudes. So the platitude is that bank stability is important. Okay, so there's been a lot of work arguing for policy intervention to stabilize banks, and these policy intervention are, you know, they have been justified on the basis of many different kinds of externalities. So this is just, of course, a very tiny bit of this huge literature. I would like just 1 second to focus on the third point. So the famous Kashyap and Stein paper from 2012. That is, I would say, probably the closest to what we are doing. So they identify that banks, because they are subject to bank failure, can cause a deadweight loss for society that they don't internalize when deciding how much intermediation to perform. So what they establish is that, therefore, a social planner should be taxing banking. Okay, so what a common thread of all these externalities is that banks are taking a decision, and this decision is wrong, so from a social perspective. So we depart slightly from this, and we study a saving externality. So those who are making the wrong decision from a social perspective in our model are savers. When they decide how many funds to supply to the banking system, they don't internalize that this choice affects bank stability. Okay, so well, let me first say that we take a standard banking model with endogenous runs. So this is Golson and Pausner 2005. and we add the new margin. The new margin is that consumers have a choice of have an alternative use for their endowment. And so they have a choice of how many funds to provide to the banking sector. So a very quick bird's eye view of the model is that there are 3 dates. So there's time 0, time 1, and time 2. And there's consumers and banks. So the key feature is that there is idiosyncratic liquidity risk. So consumers, well, the novelty in our model is that consumers enjoy for sure consumption at time 0. And then they enjoy consumption either at time 1 or at time 2, but they don't know ex ante at which time. And this we call liquidity risk. And this risk is idiosyncratic. There will be a fixed share of people who are early types, they consume at time 1, and a fixed share who are late types, consume at time 2. We're going to focus on 2 different kinds of runs. We're going to focus on fundamental runs that are runs that cannot be avoided by a lender of last resort, and panic runs. And we we pin down a unique, we will address panic runs with the global games. I'll be a little bit more specific later, but not much. Okay, so like I said, the novelty is that consumers have an alternative use for their resources. The simplest way we could do this is just they can consume them at time 0. Okay, so what are the decisions that we model and that are important and that I'll talk about? So at date 0, banks, the banking sector, or the representative bank offers a deposit contract. This is standard it's going to be exactly as in Goldstein and Pautzner, and therefore I will spend almost no time in this presentation talking about it. The choice of the deposit contract is optimal from socially. So it's the same that a social planner would do. And so this is not particularly interesting. Deposit contract is telling you the interest rate of holding a deposit until period 1 and the interest rate of holding a deposit until period 2. Now, the 2 decisions that I'll be talking about in this presentation are particularly at time 0, consumers decide how much to save, big D. All savings are intermediated by the banking system. And at time 1, consumers are gonna observe the economy's fundamental theta, and based on this, they will decide whether they want to run to the banking system because they fear that the banking system will fail or not, or they will trust that the banking system will resist and wait until the second period. Okay, so first, let me talk about the running decision. So the running decision, so first a little bit of notation again. So this theta that I told you is the fundamental of the economy, it really is the probability of success of bank assets. So with probability theta, the project in which banks invest is successful, and then banks get a return. With probability 1 minus theta, the project is unsuccessful and banks get nothing and they fail. So we can show that the running decision is quite simple. Well, actually, this is a result that comes from the Goldstein and Pautzner paper. So there's a threshold strategy. I will call that a general threshold strategy theta tilde. And consumers run if the fundamental theta that they observe is below this threshold. I already wrote down in the notation that this threshold is a function of the aggregate quantity of deposits. This will be true in equilibrium. Now, we're going to consider 2 different economies. Okay, so in one economy, only fundamental runs happen. So there is a more specific threshold, theta lower bar, which is, like I said earlier, these thresholds are, both thresholds that we will consider are a function of the aggregate level of deposits. So you can think of this as an economy where banks only fail because they're insolvent. So it's an economy where prudential policy is perfect. And we'll consider another economy. So this is an economy where prudential policy is not that great. And therefore, in addition to runs because of insolvency, there are also runs that take place because consumers think that other consumers are going to run. These are runs due to illiquidity. And well, the particular, so what is important to know is that, like I said, in this economy, there are the fundamental runs, And then on top of these, there are more runs that are due to this panic or this coordination failure. We will pin down a unique threshold, so we don't have sunspots. We can pin down a unique threshold by using global gains. Yeah. Right, so I should say runs are not going to be something that the social planner can do away with. The social planner is, they're like a friction in the economy, and the social planner is also subject to them. So another way of saying that the social planner also has to offer deposit contracts that are runnable. The social planner is gonna, as I will show you in the slide, will choose differently how to save. Okay, so now again, I'm thinking about the saving decision that consumers would do at time 0. So how much to consume and how much to save. A little bit of notation. So the deposit contract I told you establishes the interest rate for holding the deposit for 1 period and for holding it for 2 periods, so R1 and R2. And then let's also define big delta as the welfare cost of a run. This is an endogenous object, but what matters is that you can show that in equilibrium it's always positive. So it's always costly when funds taken. Okay, so this is the consumer saving decision. It's regulated by this Euler equation. You can see the Euler equation has, on the left-hand side, the marginal benefit of consumption at time 0. And on the right-hand side, I'm not going to go into detail of this equation, but what that's saying is this is the marginal benefit of saving. And the marginal benefit of saving has to do with consumption in the future. All right, so it's the expected marginal utility of consumption in the future. Okay, so that's all well. That's kind of a standard thing. Saving is regulated by an Euler equation, but there's something missing in this Euler equation. So you can see here, this is what the social planner would do. So the social planner has an additional term. So when the social planner decides how much to save, the social planner also takes into account that the quantity that he saves affects the threshold theta tilde, so the probability that a run takes place. Also, of course, it's important, he only cares about that insofar as delta is greater than 0, which, as I told you, it is. Okay, so the social planner, basically the consumer is not internalizing his effect on financial stability. That's the story. Okay, so just quickly, why is that? Just an intuition, why wouldn't he? So the story is, we can think of it as a free riding intuition. So imagine that everybody internalized their effect on financial stability. So we have to think that a bank run is a collective act. So it doesn't make sense for an individual to run when no one else runs, or not to run when everybody else does. So in a way, consumers always follow what everybody else does. And once that is true, then what an individual, if everybody else internalizes their effects on financial stability, an individual has an effect not to take advantage of what everybody else is doing to keep the system stable, and either oversave or undersave. Anyway, not to have that term in their Euler equation. And that is where the saving externality comes into play. Okay, I'm sorry. Here. So what can we do about this saving externality? So just we thought about both a tax on deposits and a tax on bank investment, and it turns out that they have exactly the same effects. So they are perfect substitutes. And here is the proposition. So what this is saying is that there is an optimal level of taxation in this economy. And the optimal level of taxation, by the way, I should say, this will come very soon, but it can be either taxation or subsidy, taxes or subsidies, right? So anyway, the optimal level of taxation is increasing in how sensitive the financial stability is to the quantity of deposits and to the welfare cost of a run. And and is increasing in the welfare cost of a run. Of course, if runs are very costly, then the social planner, or anyway, the authorities want to address this externality very strongly. Okay, so now that we have that result, we're back to the question. So should banking be taxed? And it turns out that it depends on the sign of that derivative. So it's not clear if financial stability is increasing in the quantity of deposits or is decreasing in the quantity of deposits. This is going to be the key. Okay, so now this is the slide where I tell you. So we just have a result. The result says that when we have fundamental runs, in the economy where there's only fundamental runs, then the threshold is increasing in the quantity of deposits. And in the economy where you have only panic runs, well, then the threshold is decreasing in the quantity of deposits. So in the former, we need taxes. In the latter, we need, the optimal thing to do is to subsidize the banking system. Okay, so let's try to understand why that would be the case. Okay, so here, this is the intuition for fundamental runs. So one property of the deposit contract is that waiting longer, keeping your deposits longer in the bank is going to give you a higher return. At least the promised return in case of if the bank doesn't fail is higher. So that's what the first bullet point says. So a consumer that is considering whether to run or not is going to compare the payoff from running, and that would be U of R1 times Z, and the expected payoff from waiting. So then he gets R2 if the bank doesn't fail, so with probability theta. Now, if you look at that carefully, you can see that by decreasing marginal utility, what happens is that if you increase savings, then the payoff from running increases more than the payoff from waiting. So what this means is that there is an incentive. So if savings go up, the incentive to run increases, and therefore we get this result that more savings imply greater instability. Okay, so now let's think about the intuition with panic runs. So with panic runs, there is a difference. So it becomes important for the depositor to figure out how many other depositors run. And in this framework, the depositor is gonna attach a positive, small but positive probability that many people run in time one, and therefore if he waits, he's gonna be left with a very low return. So it's actually quite risky to wait. It's risky not to run, and so in this economy, actually people tend to run a lot. So what matters is that if you have more savings, well then waiting becomes a little bit less risky. So having more deposits kind of offers a little buffer at time two, particularly in these cases when there's a lot of people running, and this buffer, and therefore people get slightly less nervous about waiting, and we get actually that more savings reduce financial instability. More savings increase the incentive to wait and reduce financial instability. And as you see, these are the two, in these two worlds, we get two opposite policy implications in the same setting. Okay, so looking at my watch, I do not really have time to talk about the numerical illustration, but yeah, it's simple. It's just to show that we've done our homework, we've run the numbers, and so in the numerical illustration sort of confirms the analytical results. It's a very stylized model, so I wouldn't attach a lot of I wouldn't give a lot of importance to these particular numbers. Okay, so on this slide, I'm going to conclude. So we've developed a standard banking model with endogenous runs. Endogenous runs in particular pinned down with global gains, and we add the new margin. This is a saving decision. We find that the decentralized saving decision is constrained inefficient. So this is an economy where we have excessive fragility. I should also highlight for those who are interested in banking models, this excessive fragility is accompanied by insufficient maturity transformation, because banks try to correct this excessive fragility, in fact. And well, so what should we do about this? What does this model suggest to? Well, this model tells us that we have to make up our minds before deciding whether to tax or subsidize banks. We have to make up our minds what is the nature of financial crisis, of the financial crisis that occur. So if there are fundamental runs, this model suggests that people are saving too much through the financial intermediation system, and therefore we should be taxing it. But if banks are subject to runs due to illiquidity, then actually we should be helping banks with a subsidy. And this is gonna make them more stable. Okay, that's it, I'm done. Thank you very much.
Thank you, Davide. And now, Thomas, please go ahead with the slides.
Well, thanks for having me discuss this paper. I think it's a very interesting paper. Just a reminder, again, I'm also at the central bank, like I think pretty much everybody who's presented so far. So let me go right in. So I think this is a really nice paper. It's a very pure theory paper that extends a classic literature in a very nice new direction, and in doing so finds, at least to me, unexpected or interesting, non-obvious and nuanced results. So I think it's sort of a perfect. Those are two perfect features of a theory model: is to fit into a nice literature and have unexpected results. So my plan for the discussion is to go a little bit into the details of what's happening here, to show you how the pieces fit together, like exactly what the building blocks here are. Davide already did a great job at that. I'm hoping that my spin on it is useful. And then I want to dig into a little bit more of what's at the heart of this mechanism of these two different directions, whether it's fundamental runs or panic-based runs, and then I'll offer some comments. All right, so there's sort of three steps here. There's first the Diamond-Dybvig model, then there's the Goldstein-Posner model that builds on Diamond-Dybvig, and then there's this paper that builds on Goldstein and Posner, and each sort of extends the previous model in a very interesting direction. The Diamond-Dybvig model we're all very familiar with, fundamentally combines a long-term asset with consumers who have short-term liquidity shocks and therefore can't really take good advantage of this productive long-term asset, and shows that banks can improve efficiency by providing liquidity insurance. But then in the classic Diamond-Dybvig model, they're subject to these multiple equilibria, which we commonly refer to as panic runs, because they might as well not happen and everything would be fine. So they're purely due to panic. Because of this panic run feature, I think, the modeling world had been somewhat unhappy with this part of the model. So Goldstein and Posner came around with a very nice extension. They added some risk to the bank's assets and then used the global game techniques to solve the model and show that it has a unique equilibrium, so no more multiplicity. And the unique equilibrium, the outcome can either be a run or no run, and whether the run happens or not is pinned down precisely by the fundamentals. And so within this framework, you can now distinguish between fundamental runs and panic runs, where fundamental runs are those that would happen even without any strategic interaction, and panic runs are the ones purely driven by strategic interaction. And then in the Goldstein-Posner paper, the key trade-off is between of the bank that's setting up its contracts is trading off the benefit of the liquidity insurance it's providing versus the cost of panic runs. All right, so now this paper adds on top of that a consumption savings decision of the consumers, which means that they decide how much of an additional endowment to consume right away and how much to put into this bank as deposits. And so this decision determines the overall scale of deposits and of the banks. And what's interesting is that the scale affects both types of runs in interesting ways. And I want to point out that it does so even though the technology here is constant returns to scale. So it's not that there's some concavity coming from the technological side. And then here the sort of the economic takeaway is that the competitive equilibrium doesn't internalize this effect on the thresholds. And so the equilibrium is going to be constraint inefficient, and there's a role for taxes or subsidies. All right, so let's look a little bit at the details. So the Diamond-Dybvig model has this long-term asset where you invest 1 unit in period 0. If you liquidate it in period 1, you get 1 unit. But if you wait until period 2, you get a payoff. So this is a productive asset with a payoff R greater than 1. However, the consumers in this model face liquidity shocks in the short term. So with probability lambda, they only value consumption at period 1. Otherwise, they're patient. And so they can't really take full advantage of this technology, but the bank can by offering these returns R1 and R2 that go beyond what the individual consumer on their own can do. So the return offered to consumers at period 1 is bigger than 1, and therefore the return offered at period 2 is slightly less than R, such that the marginal utilities are equalized and there's perfect risk sharing. But the problem, as we all know, is that the underlying game has multi-equilibria. If everybody else runs, it's optimal for me to run, and if everybody else stays, it's optimal for me to stay. Then what Goldstein and Posner do is they add some risk to the bank's assets. So in the final period, it can either pay off or cannot pay off. And the fundamental is the probability that it pays off, which is itself uncertain. And the question is whether this success probability, once it is drawn, is revealed perfectly or not. If there is full information and everybody observes the fundamental and there's common knowledge, then each agent just decides whether to roll over, whether to withdraw and demand R1 now, or whether to wait and receive R2 with probability theta. So that pins down sort of a fundamental full information threshold for a run, where if the fundamental is below the threshold, everybody runs, and that's the simple case. The other case is when information is noisy, so people don't observe the fundamental perfectly, but this noisy signal, in that case, there's strategic uncertainty about the fraction n of other depositors who run, and because whether the bank fails or not depends on how many people run, this matters. So now the run decision or the threshold is more complicated and involves these expectations over how many other people run, yielding a different threshold theta star. And so now we have these two thresholds that are ordered, and we call runs that happen in the very low region fundamental runs, because those are irrespective of what other people do, and then runs that happen that didn't need to happen but happened because of the strategic uncertainty are panic runs. So in this paper, the interesting thing is that the consumption saving decision at period 0 pins down the size of the banking system. So the deposit side is just endowment minus what was already consumed. And this shows up in both of these indifference conditions that pin down the two thresholds. And you can already see that what's going to matter here as we increase or decrease this D are the marginal utilities at these different consumption levels. So actually it's going to be the marginal utility of consumption times consumption, but since liquidity insurance only matters if relative risk aversion is greater than 1, this product is decreasing in C. So whenever you see this product, you can just think of the marginal utility driving everything. All right, so what happens to the fundamental runs? Again, this threshold is pinned down by this condition where whether you run or whether you stay. And the result here is that more deposits, so a higher D, increase this threshold and therefore increase fundamental runs. Why is this? Well, because the marginal utility is higher in period 1 because consumption is slightly lower there. And so as you marginally increase consumption, you're at a steeper slope there than in period 2. So there's a slight imbalance increasing the incentive to run. And so this effect is not taken into account by consumers in the competitive equilibrium. So they choose a slightly too high level of deposits. And this sort of seems initially as the intuitive result because we tend to think of excessive borrowing, excessive investment. So you could think of this as excessive deposits, but it's important to keep in mind that it's not because the bank's becoming more levered or some other thing. So it's really something nuanced about the marginal utilities and the underlying risk-sharing economics. And this becomes even more clear when you look at the panic run, where you're looking at the expected utility of running, which depends on whether the bank fails or not, and the expected utility of staying, which again depends on whether the bank fails, which is driven by how many other people run or stay. And here the direction is the opposite. So higher deposits decrease panic runs, which is kind of surprising. And the reason here is purely driven by this term on the right-hand side, which is the expected marginal utility from rolling over. So expected period 2 marginal utility, where the expectation is taken over what other people do. So it's the strategic uncertainty that's driving it. And under strategic uncertainty, the marginal expected utility is higher in period 2 because you're integrating over very, very low consumption values, where the extra consumption given by this increase in D has a really big marginal utility effect. And so that gives this opposite result, that when you're thinking about panic runs, competitive agents will undersave. All right, so in terms of the big picture, the paper shows us that the scale of deposit has effects on both the fundamental runs and panic runs, and competitive agents don't internalize this. So that's sort of the framing as a question of taxing or subsidies. The direction of the inefficiency depends on which type of run we're looking at. So the main question for me is how to think about this ex ante, and Davide in the presentation framed it as sort of 2 types of economies, one driven by fundamental runs because it has very good prudential policy, the other one driven by panic runs. I think this would be useful to explain a little bit more, because this is sort of the key of your takeaways, which policy recommendation is relevant. And I would think a little bit also about the empirical literature that's been trying to document or distinguish actual runs, whether they were fundamental driven or panic driven. So I think, you know, there's a little bit to add there. So in sum, I think this is a really, really nice theory paper, building on some classic modeling settings with a new interesting extension and getting very good and interesting results. And the 2 things I would like to flesh out is a little bit more of the economics or the intuition for what these, how we think about these marginal utility effects that are driving everything, because they're not really, it's not something we've had in the banking literature so far. And the second thing, as I just mentioned, is how to think of this fundamental versus panic runs, you know, in a reduced form empirical way. Thank you.
Okay, thank you very much, Thomas. So Davide, if you want to discuss about these 2 points, I also invite other participants to write in the Q&A.
Yeah, so first of all, let me thank Thomas very much, especially because he accepted to discuss our paper, which is very much a work in progress. So I'm sure that it wasn't always easy to read through it. So yeah, I think you're pointing, Thomas, in the sort of in the right direction. So you're pointing in the direction in which we're putting, at least we're trying to work at the moment, and that is to understand exactly what it means to, like, a fundamental run economy versus a panic run economy. One way we've been thinking about this, like I mentioned in the presentation, is it's about, you know, how well prudential policy is working. Another way that we've been sort of throwing around is that maybe, you know, these 2 things coexist in an economy, and one is the traditional banking sector that has, for example, deposit insurance, and the other is the shadow banking system. And maybe this gives a little bit odd, I don't know. I mean, the implications of that would be that you should subsidize the shadow banking system and tax the traditional banking system, which we're not yet sure how to think about. On the other hand, the government is providing a service to the traditional banking system by, you know, supporting its liquidity needs. So, okay, So that was one thought. And the other great point you make is that, yeah, we need to think more about exactly what these, you know, what these are nuanced results, like you said. I agree wholeheartedly. And yeah, exactly what these, it would be great to have a more linear story about what these marginal utilities mean. So far, I think we have a solid story about, you know, why consumers don't internalize this, and this is already something, and I would call that for the moment the heart of the paper. You know, if financial stability depends on size, well, consumers won't care, and therefore you should intervene. Why we show that financial stability does depend on size in these models, we're still working on exactly, or, you know, on a why, on a better why, I guess.
So there are also two questions, one from Dimitrios and one from Miguel. So please go ahead with the questions.
Hi, Davide. Congratulations. It's a very good paper, I guess, in the right direction, as Thomas said. I would like to ask you, we know in the Goldstein and Pausner paper, the probability of bank run that depends on the fundamentals depends on a particular functional form. What sort of form have you used in your paper, and how, whether you have conducted any sensitivity analysis of that form, and whether you can have an endogenously determined probability of a run depending on the fundamentals of the economy, as people have done in other papers. That includes Kassiap, myself, and others.
Yeah, so did I understand correctly? The question is, what is sort of the probability distribution of the fundamentals?
Yes, and the theta of D, there is a functional form, right? That's how Goldstein and Pausner are doing it. And the question is whether you can, what kind of a form and probability distribution you have used, and whether you have toyed internalizing, making this endogenous.
Yeah, okay, so great. We've used a uniform, which is just for simplicity. In fact, we have, so probably my co-authors who are more specialists of global games should answer your question. But yeah, I think that for now we've been content working with this. And of course, this is, you know, making this, having more endogeneity there would be interesting. Yeah, sorry.
Because you realize that the point of Thomas about the marginal utilities depends on the uniform distribution. So by playing around with distributions or playing around with endogenously determined thresholds, that might create some sort of, you know, can flesh out more interesting stuff out of it.
Okay.
Yeah, actually, I can second that. I think that's a really interesting comment by Dimitrios. So you're using the uniform distribution. So in these integrals, you don't have any density showing up. But if you had a density, it would be multiplying the marginal utility. So if there was very little probability mass in the states, that would counteract sort of these high marginal utility in period 2, probably.
Okay, I see. Thanks. That's interesting, and we hadn't thought about that. At least I haven't. Great.
Just a very quick, this is a very tangential thing, and these would probably like be a completely different paper, but I think it would be interesting to do like some even just like back of the envelope calculations for, let's say, for the United States, because to me it's not obvious what's going on in terms of whether deposits are taxed or subsidized. So first you have obviously like the first distortion is the FDIC, which it's not clear if it's a tax or subsidy for depositors. I guess it will depend on risk aversion, things like that. And then you also have the rising market power in retail banking, and that sounds a lot like a tax on depositors.
Mm-hmm.
So just like some, it's a very simple model to take the data, but I think you could potentially say something about these trends, whether, how do you think about these trends under the light of your model?
Yeah. Yeah. Thinking about, yeah, in fact, the first place where we looked, where we, you know, trying to connect these taxes to the real world, we've been thinking about you know, the distance between the interest on reserves and the market rate. That is the first place. And there is also a huge literature, of course, which also makes it interesting to be able to connect. This is the point that you made is actually very interesting, and we hadn't thought about it, but we should. It's about market power. So, I mean, in one way, market power should give extra profits to the banking system. So, but it also represents a tax on the depositors. Yeah, I mean, within the settings, because it should discourage depositors from putting their money in deposits. So it should be sort of the same thing as a tax on financial intermediation.
Yeah, so maybe market power has extra implications for financial stability over and above the traditional old franchise value thing. Yeah,
yeah, that's great. Thanks a lot.
Thank you very much. Thank you, Thomas, for the great discussion. Thank you, David, and thank you for the comments. And now we move to the last paper of this session by Tatjana. And please go ahead. Thank you.
I can hear me well. So let me start by saying thank you to the session chairs for including our paper to this very interesting session. This is joint work with Dimitrios, who is on the panel, as you can tell, and who will later join the Q&A. And no disclaimer applies to this presentation. So it doesn't, yeah, no. To motivate our paper, let us all recall that before the COVID crisis, there had been a growing concern among the banking sector, but also among a number of policymakers about the unintended consequences of a decade of zero and negative interest rates on bank profitability, and ultimately therefore on financial stability as well. And as a result, there had been several calls for central banks to depart from the zero lower bound, in particular considering the growing consensus that central banks also ought to preempt against financial imbalances in the system. But we were wondering, are critics' concerns for bank profitability really a justification to lift policy rates off the zero lower bound? We conduct a theoretical experiment to shed light on how a departure from the zero lower bound affects bank profitability, default, inflation, and output when the central bank considers, on the one hand, only monetary policy objectives, so its classical dual mandate of stabilizing inflation and the output gap, or when it also considers financial stability objectives. And we do that in a two-period monetary general equilibrium model with a banking sector, collateral default, which we will embed in the mortgage market, and a monetary and regulatory authority, let's call it the central bank, which next to its classical dual mandate also has an additional financial stability mandate. Now, the trade-off that we have in mind when thinking about whether it actually makes sense to lift policy rates away from the zero lower bound, in particular considering a disinflationary or even deflationary regime as we're currently observing in the euro area, that trade-off is really about whether the central bank is concerned, on the one hand, more about restoring inflation at target, propping up investment, and closing the output gap, in which case it may want to keep interest rates low, which it has been doing. And on the other hand, whether the central bank is more concerned about restoring banks' profit margins, disincentivizing banks from investing into riskier asset classes, and increasing the reversal interest rate, in which case it may want to increase interest rates. But is that really the end of the story? We think that there is another salient channel, in particular against the backdrop of still very high and now even increasing private debt levels, zombie credit and the like in the euro area, and that's the default channel. The idea is that as interest rates rise, that exacerbates debt service costs of private borrowers and increases their default risk. And if that default risk materializes in higher default losses, then that will give a downward drag on banks' balance sheet. And higher default losses, in turn, may also put downward pressure on the price level. So based on that, it's not really clear whether departing from the zero lower bound would help the central bank in achieving either of its objectives. Now, we want to stress here that we're not answering a normative question. Instead, we pick one of the most prominent arguments advanced by the public and assess its viability in light of the trade-offs that the central bank faces. And we think that this question is still important despite the COVID shock, because the crisis essentially only postponed the question as to whether to depart from the zero lower bound, but it hasn't made it obsolete. Now, our model is very rich in its implications, but I just want to give you a brief teaser on the main results. So importantly, at the zero lower bound, away from the zero lower bound, we cannot restore banks' profit margins in contrast to popular beliefs. And this is because of two reasons. First, any gains in interest rate margins that we would expect when lifting off from the zero lower bound are offset by higher losses from default on mortgages on banks' balance sheets in bad times. And second, the central bank sets the optimal interest rate corridor such that it is actually tighter in booms so as to limit credit supply, and it is wider in busts so as to support bank resilience. The default channel matters in our model because it results in a price externality that bears on banks' balance sheets and that puts downward pressure on the price level through Fisherian debt deflation forces. We also find that optimal monetary policy achieves lower volatility in inflation and output across states of nature when the central bank considers an additional financial stability mandate. And finally, we argue that it is important to complement monetary policy by a prudential instrument when there is an additional financial stability externality to be targeted, much in the spirit of the Tinbergen principle. We use a two-period endowment economy with a finite number of states of nature in the second period, and we embed that in an otherwise standard banking model with a commercial bank that intermediates funds between heterogeneous households, a poor household that borrows from the bank, and a rich household that lends to the commercial bank. The commercial bank also deposits excess reserves intertemporally with the central bank's deposit facility, and it borrows intertemporally from the central bank's lending facility. Mortgage default in our model enters akin to Goodhart, Tsomocos, and Varoufakis. So the mortgage that the poor household takes out is collateralized by housing collateral. And in some states of the world in the future, that housing collateral endogenously, the value of that housing collateral endogenously falls below the value of the underlying mortgage. That triggers default on the mortgage and foreclosure of that housing collateral. The two key sources of inefficiencies in our model are really our transaction technology, money and cash in advance constraints. You may also call them liquidity in advance constraints if you prefer that. And the existence of collateral default, which generates a price externality or fire sale externality. Markets in our model are incomplete in the sense that agents cannot optimally share risks across all states of nature. So they cannot design optimal contracts to rule out default and equilibrium. So there will always be positive default losses in some states of the world in equilibrium. Very briefly, households derive utility from a consumption good and housing. The maximization problem is pretty standard. I don't want to spend too much time on that. But importantly, the question, how do we model mortgage default? So the poor household takes out a mortgage in the first period in order to finance the purchase of housing. And in the second period, it repays the mortgage. In good times, it is able to repay the mortgage in full, meaning that any additional money spent on housing plus the mortgage repayment has to be financed by rolling over short-term debt from the commercial bank, using its monetary endowment and seniorage transfers that it receives from the central bank and takes as given. However, there are also some adverse states of nature in the second period in which the value of the housing collateral endogenously falls below the value of the mortgage. And that triggers mortgage default, which relaxes the budget constraint of the poor household. What happens to the commercial bank in that case? Well, the commercial bank effectively receives the face value of the mortgage plus the effective return on the mortgage. And in good times, that effective return is simply given by the ex-ante contractual return that is agreed upon when making the contract, which is determined by the market clearing condition. But in the bad states of nature, default is triggered, so the commercial bank seizes the housing collateral and has to immediately resell it in the market at the current market price. So the effective return that the bank receives is just a fraction of the recovery value of the foreclosed housing collateral over the total face value of the mortgage. And this is where the fire sale externality kicks in, because the housing collateral is immediately resold in the market. What's more, the commercial bank is perfectly competitive. It maximizes current and expected profits, less a penalty from violating the capital requirement, which is a fraction of risk-weighted assets. And to give you a brief overview of the stylized balance sheet of the commercial bank, it invests in the long-term mortgage and in short-term intratemporal loans with the households. And it also deposits excess reserves with the central bank at the deposit facility rate. It finances these positions through outside equity, household deposits, and intratemporal central bank loans from the lending facility of the central bank. Importantly, in our model, because the reasons to be at the zero lower bound in our model are actually outside the scope of what we can do, we set the deposit facility rate exogenously at 0 in the predetermined setup period. And then the central bank endogenously determines the lending facility rate. So it still endogenously determines the interest rate corridor. Moving over to the central bank, it operates in the market for inside money, extending loans to the commercial bank and taking on excess reserve deposits. And it is also endowed with a finite stock of outside money, free and clear of any debt obligation in every state of nature in every period. The central bank's objective function is a Taylor type rule of objective function, which we augment by financial stability objectives. And it optimizes by setting the future lending facility rate, as I just said, and the capital requirement. Now, we assume that the central bank cares about the resilience of the financial sector. So it is proxied by bank profits, which the central bank tries to maximize. It also cares about the repayment of claims. So it wants to minimize losses from default on the mortgage. This is to say that the central bank tries to internalize the price externality in its monetary policy decision. It also wants to minimize deviations from target inflation and minimize the output gap, where output is proxied by trade in the model. We argue that, or we justify the inclusion of both bank profits and losses from default in the model, because first, in practice, they determine banks' capital ratio and hence their solvency in distinct ways. And also in our model, they address the two sources of inefficiencies, default and liquidity, in two distinct ways. And we want to stress here that this is really as close as we can get to a social planner's welfare function, given our constrained Pareto suboptimal equilibria in the model. Finally, we also vary the weights on the 4 different objectives of the central bank, because we are interested in how the relative importance of these objectives changes the outcomes that the central bank can achieve. Then, given this model, we develop a program to solve numerically for a general equilibrium. We do so by simplifying the model to 2 states of nature in the second period, one good state or boom state, and one bad state, bust state, in which default occurs. And the central bank is also limited to setting 2 policy instruments, the state contingent lending facility rate and the capital requirement in the first period. Sorry, the state contingent lending facility rate in the second period. So again, recall that the deposit facility rate is initially predetermined at the 0 lower bound. What we then do is we examine the effects of exogenous shocks to that deposit facility rate. So this is to say that we lift the deposit facility rate, which is the floor of our interest rate corridor, off the zero lower bound in our simulations. And we simulate our general equilibrium over a grid of 20 basis point increases of the deposit facility rate and the lending facility rate in the first period. So for different widths of the interest rate corridor in the first period, we then assess how the central bank optimally sets monetary policy in the second period. In the interest of time, I'm going to spare you the parameters and the initial equilibrium values and just move on straight to the results. So this is a very condensed overview. Apologies, I'm sparing you a lot of details here of the model. But overall, the popular claim that bank profitability increases as we depart from the zero lower bound does not obtain in the model. Losses from mortgage default actually rise in bad times as we depart from the zero lower bound. As debt service increases away from the zero lower bound, agents face problem rolling over their short-term debt in the budget constraint that I showed you earlier. And so the problem is that both their overall debt service increases, and at the same time, the endogenous value of the housing collateral falls because cash constrained agents trade less. And so the recovery value of the mortgage falls and default losses increase the further we move away from the zero lower bound. And that bears on banks' balance sheet in bad times. Note that even in the boom state, the gains that we would expect from departing from the zero lower bound from higher interest rates do not materialize. As the central bank has rational expectations about default occurring in some states of the world tomorrow, it actually wants to set the optimal interest rate corridor at a tighter level in booms so as to disincentivize banks from extending more credit. And these tighter credit spreads are then passed on to financial intermediation so that banks' profit margins actually shrink. The question remains, why is it optimal for the central bank to tighten credit spreads in booms? And that's essentially because the central bank is trading off a tighter corridor so as to limit the credit boom that would otherwise feed back into default losses against a wider corridor to support banks' profit margins, because remember, it cares about bank profitability. And in response to that relatively stricter pro-cyclical monetary policy, the central bank, however, helps the commercial bank by relaxing the capital constraint. So the optimal capital requirement is looser as we depart from the zero lower bound, so as to compensate for the shortfall in credit extension through higher interest rates. And if you will, capital regulation and monetary policy in our model intervene at different ends of the yield curve. So really, monetary policy intervenes at the short end of the yield curve and capital regulation at the long end. And I'm running short of time, but just surprisingly, the central bank manages to bring deflation closer to target inflation in the model. But at the same time, output, so proxied by trade, suffers from default losses and tighter liquidity constraints. But what I actually want to focus at the end of this presentation is the question as to how and whether financial stability objectives actually really matter in the central bank's objective function. So what we do to assess this question is that we run two simulations, one in which the central bank follows only a classical dual mandate, completely ignoring financial stability objectives altogether, and one in which it attaches equal importance to both monetary policy and financial stability objectives. And bear with me here, I know these graphs are a bit of an overkill, but on the x-axis, you can see the deposit facility rate, so the floor of our interest rate corridor in the first period. And on the y-axis, you can see the lending facility rate, so the ceiling of our interest rate corridor in the first period. What we then do is we assess the different levels of bank profits that the central bank can achieve for different initial interest rate corridor sizes in the first period. And the blue line here represents the levels of the deposit facility rate and the lending facility rate where they're equal. So what I need you to do is to just focus on the right part from that line where the interest rate corridor is positive. plotted in dark red are the levels of bank profits that can be achieved for various interest rate corridors under a pure plain vanilla dual mandate. And in light red are the levels that can be achieved under an additional financial stability mandate. And we plot these surfaces for both the good state of nature and for the bad state of nature. And what we can see here is that if the central bank only is concerned about monetary policy objectives, it can achieve higher levels of bank profits in the good state, but it falls short a lot on bank profits in the bad state of nature. Essentially, it is trading off higher profits in the good state against bad profits in the bad state by not internalizing the effects of its policy rate decision and capital regulation on the economy. And we can see the same pattern for default losses as well. So if the central bank does not internalize the effect of its monetary policy on the price externality of default, because it simply doesn't incorporate that objective, then default losses will be much higher for any given initial interest rate corridor. And we can see the same pattern as well for inflation and output, but because I'm already over time, let me just say that what we conclude from that is that by neglecting financial stability objectives altogether from its objective function, the central bank accepts that inflation, output, bank profits, and default will be more volatile across states of nature, not intertemporally, but across states of nature. And so consumption volatility will also be higher. And this is because it does not follow the Tinbergen principle, where for any externality that it has, it also incorporates one target. So what I want you to take away from this presentation is really the most pertinent of our findings is that our results do not support the popular claim that gains in profit margins materialize when departing from the zero lower bound. In our model, the price externality from mortgage default and liquidity friction in the cash and advance structure represent two sources of inefficiencies that cause welfare losses. The central bank tries to internalize these sources of inefficiencies through pro-cyclical monetary policy, which is complemented by looser capital requirements. And in so doing, the central bank trades off the effects of its policies on default losses on the one hand and on credit supply on the other hand. And importantly, if the central bank neglects financial stability considerations altogether, then monetary policy increases the volatility of inflation and output across states of nature. And what has yet to be addressed is actually an endogenous liftoff from the zero lower bound, because we're well aware that in our two-period model, we're really just looking at exogenous shocks, so an exogenous liftoff from the zero lower bound. Thank you very much.
Thank you very much, Tatjana, for the great presentation. And now Daria Finocchiaro will discuss your paper. Daria.
Thank you for giving me the possibility of reading and discussing this very interesting paper. It's an elegant two periods model and which generate interesting results. So I think it was very interesting and really food for thought. So what are the, and I also work at the central bank, it's very expensive. So these are my views and not the executive board. So what are the key questions that this paper is asking? Is like whether lift-off, like raising interest rates from the zero lower bound, is something that is beneficial for bank profitability, but also what are the optimal monetary policy and macroprudential policy as we move away from the zero lower bound. And the way these two questions are asked are like performing a set of exercise policy experiments. The first one is like to compute the optimal lending facility rate and the optimal capital requirement when the deposit facility rate is exogenously fixed at the zero lower bound. But then also evaluate how this optimal monetary and macroprudential policy will change in response to an exogenous increase in this like deposit facility rate. And what I want to stress here, something that Tatjana already made clear in her presentation, is that one, when we talk about optimal policy here, it's it's from the point of view of a monetary regulatory authority that minimize an ad hoc loss function. No? Two, that when we talk about lift-offs, is really like an exogenous increase in the deposit rate. What this paper is doing is like providing a new interesting channel to look at this question, whether lift-offs are beneficial for bank profitability or not. So we know that it's like after a long period of low rates, that could have unintended consequences on bank profitability. And at the end, about what we care if we're working at central banks about credit supply. So, and higher interest rates increase bank profitability via their effect on interest rate margins. But its higher interest rate can also increase default losses in bad times, which is also a threat to financial stability. And in this paper, what it does is like changes in the central bank rates are transmitted one-to-one to households by perfectly competitive banks. So how does it work? The monetary transmission mechanism, whenever like the deposit facility rate change, also the rate that savers and depositors will pay, they will receive on their deposits will change. Whenever the lending facility rate will change, also the rate that on short-term loans that households pay will be changed, which means that will make even more, will have an impact on how the cash in advance constraint, the liquidity, the transaction constraint works in this model. So they consider like two different states of the world, and what happened in this model is like if we are in a downturn, the price of non-durable goods increase, price of durable goods decreases, and this will make households default. And it's also shown that the further away we are from the zero lower bound, the bigger the losses are from default. And this part of the paper, it's quite understandable and close to what we would expect a priori. What is a bit less obvious is like what happens in the boom, because there are similar effects on prices, and the further away from the zero lower bound, the smaller are bank profits. So you see that increasing interest rate here is really a no-brainer, because it's something that is not good for bank profitability, but also increase bank losses if we are in a bust. And what's interesting to note is like it doesn't matter whether we are in a downturn or in a boom. Well, what the central bank does is always increasing lending rates. And in the calibration that they use as an example at the beginning, central bank increased lending rate quite a lot. So my first question is, or comments is really about the relationship between lift-offs and bank profits in booms, because that's I think it is really an interesting result, and it deserves further clarification. Because what higher rates do is like increase the false losses in bad states, but do not have a positive effects on bank profits in a good state. And what's generating for these results is the optimal response of central bank. Now, what's happening is that away from the zero lower bound, the optimal interest rate corridor is tighter in booms. So because the central bank is concerned about credit expansion, so to limit credit expansion even in booms, central bank will raise interest rates. Now there are like many channels going on at the same time, and it would be interesting to understand if these results is also driven by the default channel even in booms. Because what I was thinking is that it would be also interesting to understand if this is really a result of something that is related to the way monetary policy, the way the loss function is specified, the weights to different objects in the loss function, but also the fact that so given that these weights and the loss function, they are something chosen ad hoc, I guess there must be a combination of weights that reverse the results, and it would be interesting to understand what's such a combination. Also, like the loss function is specified in terms of bank profits, but at the end we care about bank profitability because we are worried about the fact that a low profitability could have on credit supply. So maybe it would be interesting to consider a loss function that has credit supply and growth, credit supply growth like on as a target. So in general, I think given that this is like a counterintuitive but interesting result, it would be interesting to have more experiments to single out the main channel behind this result. So the other result that I think is maybe counterintuitive is that the model generates qualitatively similar response of the economy in good and bad states of the world. And when we look at the way that the supply shock or like different states are defined in the simple calibration exercise, I'm not sure that this is really a supply shock, because what's happening is that in different states of the world, there are like many exogenous variables that are changing, both real and nominal endowment. In particular, like a bad state of the world, state number 2, it's a state where poor households have less potatoes, banks have less capital, but also like poor households have more money in good states of the world. Rich households have less money in both bad and good states of the world. And the central bank has less money both in good and bad states of the world. So you understand it's like it is a bit hard changing all these exogenous variables to understand what's really what's the transmission, how does the model work and what's the transmission mechanism here. Because what's happening is that in good states, house prices decline because short-term lending is more expensive. In bad states of the world, house prices decline because rich households have less money, poor households have less potatoes to sell, and far sell depress prices even further. So I would have liked to see like an experiment where we change only one exogenous variable in different states of the world to understand really how the model works, because it is like a simple model, but it's quite rich, and then it would be nice to see that this kind of experiment. Then I have a first comment is about the relationship between monetary and macroprudential policy in this model. Because here, one of the results is also that the further we are from the zero lower bound, the looser macroprudential policy, the looser capital requirement should be. And this is the result that it's in contrast with what Caterina and co-authors found and me and co-authors found in another paper about borrower-based measure. Because there, like in an environment with little scope for central banks to cut rates, macroprudential tightenings can entail quite significant macroeconomic costs in the short run. Here, so there, and in those models, like in dynamics models, there is a trade-off between long and short run, which is very difficult to capture in a two-period model. Finally, I didn't quite understand why a dual mandate can increase inflation and output variance. Why, like a central bank that cares only about inflation and output, would result like choosing an optimal policy where these two targets, the variance of the two targets increase. Because even if the central bank does not explicitly target default, it should internalize the effects of defaults on the target variables. There are some missing channels that are missing that could be important that are missing in the current analysis. Now, I don't mean that the paper they should change the model, because as I said, it is quite rich as it is. But I guess it would be interesting to have a discussion about how these different channels could impact on the results of the paper. And I'm thinking about non-linearities in the monetary policy transmission mechanism. So the fact that monetary policy transmission mechanisms could also be impaired when rates are low. I'm thinking about the search for yield channels, the fact that low rates could induce more risky behavior by banks. And finally, something that maybe is worth looking into details is like the fact monetary policy could have a signaling effect. So for example, lift-off could be a positive signals about the future solvency of high credit risk borrowers, while here rates are increased for exogenous reasons. So I think this is a very interesting paper on an important and timely topic. it is a simple model with an overlink between lift-off and bank profits due to defaults. A link that delivers like a results that is maybe counterintuitive, but also like interesting. And I think the paper would benefit from more experiment or robustness on the main channel of transmission, the default channel, and maybe also a calibration that is a bit more anchored to reality. I think it's a bit a pity that so it's a simple model, but still it's imposed. It doesn't. There are no analytical results, so all the results are then presented with numerical simulation, and then it's a bit, yeah, a calibration that is maybe more anchored to reality would help to assess the robustness of those results. Thank you.
Thank you, Daria. Dimitrios, please feel free to address some of the questions. Address what you think you should address now.
Yeah. Well, thank you so much, Daria. And these were great comments. There was a lot of great truth to it. So, and I probably cannot address all of them in the 4 minutes. I completely agree with you that there is a lot of channels going on the model. And the one that we want to focus on is the default channel, but that doesn't mean that there are not other ones as well. Not the ones that you mentioned at the end, which are absolutely worth a discussion, especially in the literature review. But especially the liquidity channel that goes via the cash in advance constraints is also of high relevance, and that interacts with the default channel. And you're probably right in that that merits a more in-depth discussion to make it clear in the paper. Regarding additional experiments, I really like the idea of instead of bank profits, including credit supply in the objective function. This is also something that is in line with the leaning against the wind literature, where buildup of credit bubbles are addressed by monetary policy. Dimitri, would you like to add something right now? Because then I can.
I just want to, first of all, thank you very much. Daria, you confirmed the theorem that says, the papers are read by the authors and the discussants, perhaps nobody else, but anyway, you confirmed that part of the theorem. So thank you very much, and we would appreciate your notes. I would like to make a point with respect to the importance of the endogenous channel of default. That's what drives all the results, and whatever seems a little bit counterintuitive, it is because default is endogenous and not exogenous. In other words, where the value of the collateral is endogenously determined, and thereby we decide whether it will default in the bad states, and that reduces the expected profitability. And then if you add the additional goal of to correct of the externality of default and the financial stability, then you want to limit that very incentive to search for yield and gamble to resurrect in the good state of nature. That's why you want to tighten the spreads. In other words, I think the key thing that drives all of these things is that to understand 2 points. First, the Tinbergen principle, that this kind of very simple model has more than one externality, and trade happens. The classical dichotomy does not obtain. That's why I don't want to have credit supply. I want to be as close as possible to the first principles, so that to be close to the arrow Debré, and therefore to see how by playing around with the slope of the yield curve by intervening either, as Tatjana said, in the short end of the yield curve with the monetary policy, or the long term of the yield curve with macroprudential policy or quantitative easing, to see how the Schulze equation and the trade-offs vary with each other. And given that I have 2 externalities, basically I confirmed the old principle that you need 2 tools to correct for 2 externalities. It's like as many policy objectives you have, so many tools you have. I think the very interesting thing is, and I understand, and I take it, and I agree with you, Daria, we need to have some sort of more calibrated results so that to enforce, to reinforce and to empower, if you want, the relevance of the results to the economic conjuncture, despite the fact that it's very difficult to do this in two periods, so that's correct. And more importantly, is your point to have some more experiments to try to single out, even though we tried one by one the various channels, which again is not very easy, but it warrants and it's worth the effort. So all in all, thank you very much. And I think, you know, most of these things, you'll see them after the referees respond to what we have done so far. So thank you very much for all of your comments.
And since time is over, I would like to thank all of you for the great presentations and discussions. And I hope to see you soon again, maybe physically next time. And thank you.
Thank you very much.
Thank you very much.
Thank you, Tatjana.
Thank you.
Thank you all.
Thank you.
Thank you very much.
Bye.
Thank you.